Our next guest says today's cut is an insurance cut against a weakening labor market. Let's bring in Claudia Sahm, chief economist at New Century Advisors, creator of the Sahm Rule. Claudia, it's great to see you. Let me just set this up a little bit because we had Jason Furman earlier saying we shouldn't cut because of inflation and because of the deficit. Those pressures are still too high. Obviously, others are more dovish. They think that we can and should. Explain where you come down on this.
Right. So I think it's appropriate for the Fed to be cutting again today. I was on board with the two cuts they've done this year. Frankly, the risk of a deterioration in the labor market. We're not there now. We don't see signs of it right now, but we've seen a lot of slowing in job creation. The unemployment rate has moved up for 3 consecutive months through September. That is exactly the kind of dynamic we do not want to see keep going and building. And so what the Fed is doing is they're taking out some insurance and trying to really buffer the labor market so that we don't end up in a recession. There is no reason, inflation is elevated, but there is no reason to stand by and let a recession take hold.
So you think the labor market signals are becoming more worrisome?
I think when you look at the risks, the downside risks to employment are more substantial than the upside risk to inflation. They're both there. This is a tough call. You can make a case on either side of it, but I think when you bring all the information that the Fed has right now about the economy, it's on the employment side where things are more worrisome, and they have the ability to take another cut, take some restriction out. It might not solve the problems, but it certainly means that the Fed isn't contributing to even more slowing in the labor market.
What about the argument that the job cutting is either in response to overhiring during COVID, perhaps some outmigration happening, perhaps also some AI disruption, in other words, not issues that the Fed should react to?
Right. So back in the summer when Chair Powell talked about the curious balance of the labor market and, the demand and supply, they could both be the reason the job creation is slowing. I think, that is happening. That is absolutely there. But as we have gone further into this year, it is more and more clear that a weakening demand for labor is what's taking over. And we got more information today on wage growth, that it has continued to slow. That's what happens when there's less demand for workers. And so I think and again, the unemployment rate rising is another sign that demand is winning in terms of that demand supply. And you want the Fed to be reacting to that.